Hello, this is Tom Siamatis, Chief Market Economist here at AE Wealth Management. It's hard to believe that we're already halfway through 2026. I hope everyone's doing well and getting geared up for the summer. The World Cup is in full swing and the Iran situation has settled down. As you can imagine, the second quarter was dominated by the conflict in Iran. Even though the bombing stopped shortly after Q2 started, the U.S. implemented a blockade of Iranian ports, and alternatively at times, Iran said it was implementing its own blockade of the Strait of Hormuz. There was the random drone and rocket attacks from Iran on its neighbors, while Israel continued to destroy and degrade Hezbollah and Lebanon in the background. The on-again, off-again hopes of a deal or the threats of renewed military strikes in the region was enough to keep markets on edge most of the quarter, but still moving upward. Inflation began to climb as oil prices remained stuck in the $90 to $100 price range per barrel for most of the quarter. Inflationary fears pushed yields higher as well. Things began to turn around towards the end of the quarter as terms were agreed to between the U.S. and Iran, which allowed for the lifting of the blockade and for oil to start moving through the Strait of Hormuz again. U.S. equities did well after a rough first quarter. Markets recouped their losses and advanced to double-digit returns in the second quarter, with the S&P 500 breaking above 7,600. We came tantalizingly close to 7,000 in the first quarter a bunch of times, but once the market caught wind that the worst of the Iran conflict was behind us, we blew past that level very quickly. The Dow rose to a hair below 52,000. The Nasdaq closed above 27,000 for the first time as records were set all the way around in June. Despite the Iran crisis and oil prices dominating on a daily basis, there were other themes that were relevant for the markets. Earnings have been stellar so far this year, and there's been some on-again, off-again rotation into and out of AI and mega-cap tech stocks. There was also the hype surrounding the SpaceX IPO, which seems to have cooled somewhat. Drama with the Fed, as Kevin Warsh replaced Jerome Powell as chair, and a shift in policy were some of the other U.S. market drivers in the first half. International markets have lagged the U.S. year to date, and the second quarter was no exception, with the only highlight being Japan, which is up nearly 40% so far this year. Most of that was in the second quarter. The Nikkei 225 climbed to over 70,000 for the first time ever. Much of that has been driven by the AI and semiconductor boom and pro-growth policies from Prime Minister Sanae Takaichi. As for the European and the rest of the Asian markets, both were hurt by higher energy prices as they lagged the U.S. On the fixed income side, the U.S. 10-year note, which was yielding 4.15% at year-end, spiked over half a point in May as the Iran crisis dragged on without a deal, and it was becoming apparent that inflation had arrived and it was not going to be the quick blip we were promised once the conflict ended and oil prices plummeted. The other development was the outlook for rate cuts. Markets were banking on one or two cuts in the second half of 2026, as the Iran conflict unfolded and the price of oil shot upwards. We began to see and feel inflation, especially at the gas pump. The conversation then shifted from rate cuts to the hope that rates would remain the same for the rest of the year. Still, fears of outright hikes in order to keep inflation in check began to creep into the conversation and to scare markets. At the Fed, Jerome Powell's term as chairman ended in May, and President Trump appointed Kevin Warsh as the new Fed chairman after some drama in Congress. Warsh chaired his initial Fed meeting in June, which highlighted the shift in thinking at the Fed. Rates remained unchanged, but there were numerous voices which will quickly grow if inflation continues to rise, calling for an actual hike. The ironic thing is that Warsh was chosen because Trump wanted rates cut, and at this rate it appears more likely we will see a rate hike before we see a cut. Internationally, rates across the board were mostly lower than their U.S. counterparts, with the exception of the U.K. Then again, the rest of the world has always been more tolerant of higher prices than we have. Economic growth has been slow, but it's hard to judge given all the turmoil we have seen since the government shutdown late last year. GDP is running at around 2%, so it's a far cry from the 4% annual growth we were promised by the Trump administration earlier this year. In fairness, the economy has been far from normal, starting with Liberation Day when tariffs were first announced all the way to the most recent conflict with Iran. That's not to say the economy is bad, but I would not say it's good either. The economy appears to be just there. The first quarter of plus 2.1 GDP growth confirms that. But there always seems to be a disclaimer about why it's so low. Once we get through the tariffs, once the government reopens, once the Iranian crisis is over, once oil prices come back down, you get the idea. It's always something, but once we get past the latest one-off, we will enter the golden age economy. Again, 2.1 is not 4%. So far this year has been predictably unpredictable, and the second quarter was no exception. I believe we're in for more of the same in the second half of the year. Knowing that things are going to be unsettled is more than half the battle. Keep calm, call your advisor with questions. It always pays to be informed and engaged. Remember to control what you can control and what you cannot. And do not let the daily mayhem overwhelm you, especially as we get closer to these elections. Take a moment to breathe and try to enjoy the summer. Do not stress. You can control that. I will be back with you in 3 months as we look back on the third quarter to get another check on our progress. It's never a bad idea to review your goals with your advisor and make sure you're on schedule, and if appropriate, rebalance back to a risk tolerance you're comfortable with. Thank you and have a great summer. Be safe and take care.